Unlike real estate booms past, WeWork's subleasing spree won't leave behind many monuments. No half-built skyscrapers, complexes in Kuala Lumpur, no pointless airports in rural Spain. Instead, the money found its way into already existing infrastructure, made visible only by discrete signs or logos on windows, scattered on buildings in New York, San Francisco, Seattle, and Boston. WeWork had consistently promoted itself as asset light. Its buildings leased from developers, then after being subdivided, rented out on a short-term basis. This lightness will stand out as WeWork's true innovation into two ways. The first was that by signing leases as opposed to buying or even building, it could grow increasingly quickly as long as it was able to raise enough money to top up rent. It also built light. Contra its loudest critics, WeWork is more than just marketing spin and pineapple water. It was used all of that atmospherical things to convince workers, whether they're freelancers or employees of fast-growing companies that can build out their own space quickly enough, that they don't need as much space as they might have though. One estimate put WeWork's footage per member at around 50 square feet, well short of the office average of 250. WeWork is thus able to charge high rents for substantially less space than its competitors. But because of its pretensions to being a technology company, the offering of tenants is famously flexible. You can rent month to month and can easily expand or shrink your space according to your needs. For WeWork, this means that the revenue can vary substantially and over a year. If there were ever a large drop in demand for flexible office space, WeWork would still have its own lease payments to contend with. In its company filings, WeWork placed its average lease length at 15 years and wrote that it was off the hook for some 47 billion worth of payment and with only 4 billion of revenue commitment from those members. The company is essentially renting long a subleasing short, leaving itself exposed to the same risk as financial institutions that fund themselves with short-term borrowings while maintaining long-term funding commitments. A model that's risky, that requires an unusual source of investment, and these days SoftBank is most unusual of all. Or perhaps the second most unusual after its own partner, the Saudi government. A year before, SoftBank's Saudi-backed Vision Fund poured 4.4 billion into WeWork. In 2017, the Saudi invested directly in Uber. WeWork and Uber's involvement with the Saudi government raised hackles in the press. For a while before assassination of Jamal Khashoggi, two companies were able to pitch themselves as liberalizing forces in Saudi Arabia, helped along the government's eventual announcement that women would finally be able to drive. But when the Saudi attempted to host a Davos in the middle of the city, an investment conference soon after Khashoggi's murder, several technology and finance executives dropped out. Crown Prince Mohammed bin Salman, the brutal purge of the Saudi elite investors class, had not provoked much of the outcry from the American public and business class. Neither had the brutal war against Yemen. The disappearance of a journalist, overseen by some of the prince's closest advisors, was different. Khashoggi's killing was so shocking and blunt that even SoftBank CEO Sun was compelled to condemn it. But that was as far as Sun went. He would stay in business with the Saudis because SoftBank has accepted the responsibility of the people of Saudi Arabia to help them manage their financial resources, diversify their economy. Late that year, SoftBank publicly listed shares in its core business, a Japanese mobile company, helping effects of transition into a company that primarily invests or owns the technology of companies. These holdings includes a stake of the Chinese e-commerce marketplace Alibaba. A wholly owned English semiconductor company, and US telecom giant Sprint, as well as standalone funds for dozens of their bets, including the Vision funds, whose biggest single investment was WeWork. The fund is supposed to invest in unicorns or in companies that are or will be leaders in their sectors. Typically, these types of bets are supposed to be lower risk because companies with valuations that high have businesses that are more or less real. Though the fund is supposed to be yoked to Sun's 300-year visions, it's also promised some investors a 7% return every year. In its nexus, the between Japanese telecom company trying to turn itself into investors betting on global technology revolution, a cash-rich nation tried to diversify its economy and embed it into a non-energy global market, and an ambitious entrepreneur trying to raise as much money as possible, that the WeWork mania and the Newman's behavior came into focus. When it comes to Newman, there are two divergent theories. In one, talents let him ambition get ahead of the abilities to run a profitable business. He was simply taking what money was available and pouring it back into the company, trying to deliver the impressive revenue growth that venture capital's investors supposedly want. In a different telling, suggested by another one of WeWork's great chronicles, the journalist Newman is the genius of this period of venture capital mania. His deal to give up control over the company and SoftBank's acquisition of majority control over its only proved it further. The Japanese conglomerate, in buying $1 billion of WeWork stock from Newman, along with $185 million consulting fee and $500 million in order to pay off its loan from JP Morgan, and the Wall Street Journal reported covering $1.75 million he owed the company for using the company's private jet for surf vacation and other jaunts. Newman may have become a laughingstock, but he is a very rich laughingstock. One of the great mysteries of modern finance is how to make money when you know there's a bubble, or at least how to get as much richer than anyone else. The obvious way is to bet against the bubble, but this is difficult, as its expansion and can easily outlast one's ability to finance the winner. It's even harder if the bubble is primarily happening in the private markets, where it's very difficult, if not impossible, to directly bet against the fortunes of companies that you think is overvalued. What you can do, however, is to try to soak up as much money as possible from optimistic investors and then furiously distribute it to yourself and your family, so that by the time things turn, you are already rich. And to probably pull this off, you would need to find investors with a lot of money that they felt obligated to spend. It was just as important for WeWork to serve as a private place for Saudi and Japanese cash as it was to provide office spaces for virgin businesses. In the introduction to SoftBank's most recent annual report, Sun thanks shareholders of its support. We continue to move forward, inspired by our beliefs in the power of technology and to build a more connected, efficient, and joyful world, as expressed by the corporate philosophy, information revolution, happiness for everyone. He goes on to hail the coming artificial intelligence revolution, which is poised to redefine all industry, including education, healthcare, real estate, and finance, as well as the advertising and retail sectors. This revolution will, some intends, be funded by SoftBank. The scale suggested by The scale suggested by Sum's plan is massive, literally all industrial outputs for the rest of human history, and it's been matched by the Vision Fund, which raised about $100 billion, including $45 billion commitment from Saudi Arabia. But you still have to invest the money, or, as Sum put it, take the helm of a group of companies led by artificial intelligence entrepreneurs from all different fields, much like prominent orchestra made up by virtuous scores of instruments, and help them harmonize while creating additional value along the way. To take Sum's logic seriously, if the entire world economy is going to be transformed by a set of emerging technologies, the investment opportunity is never too big. But just because an investment is justified by a theory of how technology will transform all production doesn't mean there are enough companies actually pushing those changes to fund. One day, you may wake up and find that you're funding on-demand dog walkers, indoor farming, and an Indian hotel chain, to the continued bafflement of journalists and market observers. The private equity titan Schwartzman put it delicately when he says to CNBC, "Tech often comes with no earnings, and so if you're going to finance the expansion of an industry that often doesn't earn anything, you're going to need large amount of money to the extent you're a believer."